Hi, Jim Gore from Thor Investment Management. Have any of you had the pleasure of teaching your children how to drive? Or should I say nightmare of teaching them how to drive? One of the things that you learn or you teach them is to make sure that they're looking outside the front of the car instead of the rear view mirror. Why do we do that? Because we don't want them to get in an accident. Because if you're driving a car, look in the rear view mirror, you will get in an accident. The same thing applies to investments. People should be looking at what's going to happen in the future instead of what has happened in the past. However, they don't do that. Let's give an example. Back in the late 90s, the US stock market was doing exceptionally well, better than the rest of the world because of the tech boom that was going on here. However, if you look at the results the following 9 years, the market didn't do so well. So let's look at the numbers. If you look at the performance for the stock market from June of 1999 to June of 2008, the S&P 500 index returned a total return of 0.88% annually. Less than 1% annually, you would have done much better holding your money in cash over that time period. However, at the same time, emerging markets were up 13.81%, and other international markets, developed international, were up 5.63%. But it was also at this time in June of 2008 that Thor had no money invested in emerging markets because they were overvalued. Keep in mind, 2008, 2009, the stories were that the BRICS, Brazil, India, China, South Africa were going to take over the world, and people were throwing their money into those investments after they performed very well. So let's take another snapshot. See how well the markets have done from June of 2008 to June of 2017, the next 9 years. You can see that the S&P 500 over the last 9 years has performed very well, generating an annual return of 9.71%. However, emerging markets were only up 1.62%, and the developed world was up 2.41%. So the US market has performed exceptionally well the last 9 years, while emerging markets have not. So today, Thor is completely invested differently than we were in 2008. 2008, we were overweight US large companies and had no exposure to emerging markets. Today, you can see by the numbers, US stock market has done very well the last 9 years, so we are underweight US large companies and overweight international with an emphasis on emerging markets. What we are doing is we are driving our car looking through the front of the car, not looking through the rear view mirror. If you have a portfolio that is overweight in US large companies, you might have done well the last several years, but right now what you're doing is you're driving your car or your investment portfolio looking through the rear view mirror. What you should be looking at is diversifying your portfolio. If you have any questions or if you need help in diversifying your portfolio, please reach out to us here at Thor Investment Management.